Welcome to Invest Growth Wisdom, and today we're going to talk about Realty Income. In our recent video, we talked about how this monthly dividend company has outperformed the S&P 500 index return over the last 3 decades. But so far in 2023, Realty Income has shed almost 15%. So the question on everyone's mind is, what is going on with the stock, and more importantly, do we jump ship or should we buy more of ticker O? When the pandemic started in 2020, Realty Income experienced a fallout of more than 50%. Luckily, the decline in 2023 is not as severe so far, but investors are concerned if a similar trend is happening today. To answer that question, we are going to analyze Realty Income's fundamentals against the current macroeconomic backdrop. We will also analyze Realty Income's expansion into the gaming industry and how such a move could benefit or hurt the company's financials. Let's start with the main driver behind Realty Income's recent price drop. Have you ever noticed in daily life that when there's more of something, its value tends to drop? That's a simple principle of supply and demand. And the same principle can be applied to stock shares. Recently, Realty Income announced it struck a deal with 19 financial firms to sell 120 million common shares. More shares equate to a more abundant supply, which, you guessed it, leads to a price drop. It is not the first time Realty Income had done such a deal. The company had a strikingly similar deal in June 2022, offering close to 101.8 million shares from the agreed 120 million. What followed the deal was a swift fall, with share prices tumbling from $71 per share in August of that year to a low of $55 by mid-October, a decline of 21%. The implication? If history is any indicator, it implies the decline we are seeing so far hasn't fully priced in the deal, as the company has agreed to release another wave of 120 million shares. Many investors see this news as bearish for the stock. Interestingly, if we turn into Realty Income's core business and its fundamentals, we see that this recent share price decline doesn't truly reflect the company's growth. In 2018, Realty Income had 5,483 properties. 5 years later, that number has surged to a staggering 13,118 properties. Most of the purchases were financed with low interest rates during the pandemic years of 2020 to 2021. As a result, today Realty Income's debt almost tripled. From June 2020 to today, their total liabilities rocketed from $8.76 billion to a staggering near $23 billion. A portion of this debt is set to mature in the next few years. By 2024, they're staring at $1.8 billion maturing, and by 2026, that figure jumps to over $4 billion. Interest rates of the future remain a mystery. But since the Fed wants to keep the rates higher for longer, we can expect that at least in 2024, Realty Income will need to refinance their debt with higher costs. And if interest rates stays high for longer, Realty Income's refinance costs would drag down the company's financial health. Okay, a little pause here. If you're finding this insightful and would like to see for more, don't forget to hit that subscribe button for Invest Growth Wisdom. Dive deeper with us into the world of finance. One of the key indicators for a company's financial health is the interest coverage ratio, ICR. It's the magnifying glass that helps investors see how comfortably a firm can meet its debt obligations. Ideally, an ICR hovering above 2 or 3 is the sweet spot. As for Realty Income, they've consistently maintained an ICR above 1.9 since 2022, and as of now, the ICR sits comfortably at 2.5. Realty Income is in a good position to manage its debt servicing. Next, let's talk about values. The price per AFFO ratio is the REIT world's compass, similar to the P or PFCF ratios for conventional firms. Today, Realty Income boasts a price per AFFO ratio of 12.5, mirroring figures we saw post the 2020 crash. Apart from that blip, such valuations harken back to mid-2018. And given the ongoing 2023 share-selling saga, I am leaning towards that we haven't seen the floor on the share price just yet. Realty Income recently announced it is buying a $950 million stake in Bellagio in Las Vegas, a venture into the gaming arena. Traditionally, Realty Income's investment portfolio has often been filled with essentials including grocery businesses, DIY stores, and convenience retailers. Now it seems the company is going further to diversify its portfolio, casting the net wider across varied real estate avenues. Is this a good thing? My personal take is that gaming properties like casinos often enter long-term lease agreements, sometimes spanning 20 years. So expansion to this sector could bring a potential source of stable rental revenue for decades. If the casino's business is doing well, that is good news for Realty Income's profit down the road. With worries about a recession hanging over, many investors are concerned if the casino operation will be as profitable as before. But looking ahead, I believe it will actually strengthen Realty Income's collection of assets. Even if tough economic times hit soon in the next year or two, things should eventually recover in the long run. Next, let's delve into a topic close to the heart of every investor: dividend safety. Realty Income's proposition is simple, yet magnetic. An annual dividend just north of $3 per share, paid out monthly. But let's dissect the numbers. With a current share price hovering around $50, we're looking at a yield of approximately 6.02%. At first glance, it's an alluring initial yield. But Realty Income's magic doesn't just lie in its dividend yield. It's the combo of dividend growth coupled with capital appreciation that makes the stock one of the best performances in the last 30 years. The company has delivered consistent 3.83% growth in dividends over the last decade, making it one of the dividend aristocrats out there. Realty Income sees its price decline in the last few years, largely attributing to the pandemic and higher interest rates in the current economic cycle. Yet, I'm optimistic this company has solid fundamentals for long-term growth. As we navigate the flux of interest rates, and as they gradually find their equilibrium, I anticipate a shift in Realty Income's strategy. As the interest rate waters calm, the emphasis on share selling to fuel growth could wane, and that would signal renewed growth for both the company and its dividend. In wrapping this up, dividends remain an important part of investment portfolios. As for Realty Income, the tale is still being written. Their dividend safety, growth, and future strategies offer plenty of food for thought. Did this deep dive resonate with you? Go ahead and hit that like button, and if you haven't already, subscribe to Invest Growth Wisdom for more such insights. Dive deeper into investing with our curated content, and remember, knowledge isn't just power, it's growth, wisdom, and prosperity. Stay tuned, stay wise.